Well, hello, everybody. Thank you so much for joining us tonight. Super excited. We have Faye with us. And a little bit about Faye. Faye has been a startup. Faye is a startup junkie. As a business generalist, she spent the last 10 years wearing many hats from investing to operating and everything in between. Most recently, she was the head of operations and venture partner for the Forum Ventures, supporting 250 early stage SaaS startups. She also sits on the board of Startup Vegas and speaks, writes, and advises on entrepreneurship, investing, community, financial inclusion, and women's rights. Faye also runs YPOC, a community that uplifts, promotes, and advocates for professionals of color. So thank you so much, Faye. It's all you.
Thanks, Inez. I appreciate it. Okay, I think we can get started. Thank you for the lovely introduction. I am Faye. Today, I'm going to be talking about early stage fundraising from an investor's perspective, particularly VCs. The reason I speak on this topic is because I realize that a lot of times when you start a business, people give you a lot of the same advice. One of the biggest pieces of advice you're going to get is to understand your customer, understand their pain points, understand their problems, understand their urgency, so that you can build the absolute best solution for them. But what's interesting is that when we talk about fundraising to startups, we don't say the same thing about understanding VCs. As a matter of fact, a lot of VCs want to be as opaque as possible. And so I thought it was important to talk about this and share a little bit more about what happens on the back end of the VC side, in order for you to better understand their thought process, their thinking, what's going on the back end, why they might be delayed, or why they're not answering you, or why they're not willing to invest in you, because I think that helps us get a much better idea of how we can pitch to them to be more attractive. So I am pretty fluid in the way that I do presentations. So you guys can feel free to jump in and ask any questions if I can hear you, or I think I'll see the chat if you like drop it in the chat. Oh yeah, I was just checking to see what the chat was. But yeah, you guys can feel free to ask questions as we're going. It's pretty dense, the topic today. So we're going to be covering a lot of stuff. So please interrupt whenever so that we don't skip over that point. And I'll get started. So Inez just gave that lovely introduction, but a quick recap. I have founded 3 startups. I've scaled a startup from 10 to 150 employees and hit profitability in 2 years. More recently, I have been a B2B SaaS venture capitalist. I've scaled my fund from 25 million to 100 million assets under management. We are a pretty high volume venture fund. We're making about 120 investments a year. So that means that we see a lot of startups, and a lot of my presentation today is obviously going to be based on that experience from being on the investor seat. With that being said, I do think you should take everything I say with a grain of salt. My experience is strictly B2B SaaS. So what that means, if you're a hardware startup or if you're something else, the advice might not necessarily match one-to-one, but I'll always call that out in my presentations. And feel free to ask questions too if you want me to relate closer to one of your industries or functions. And then lastly, yeah, we at the time that I wrote this presentation, the time the bio probably written, we had invested in 250. I think now we're closer to about 400. We are making 120 investments a year. So I just lose track of the number. But yeah, a lot of investments. So today we'll cover 3 main things. One is understanding of VCs. So a real understanding of like, how do VCs get their money? Like when I say we raised 25 mil to 100 mil, what does that mean, having assets under management? How are the VCs structured? How do they make their decisions? And how and why do they decide to invest in certain startups? 2 is we're going to look at what VCs look for in a startup. So what are the considerations that they take into account? Do they, how important is revenue? How important is traction? How important are all these different things? And some of the questions that VCs will probably ask you. And then lastly, how do you set yourself up for success? Hopefully with understanding of VCs and seeing and understanding what they look for in a startup, that automatically gives you a little bit of a better idea on how to position yourself. But I'll also end with a few tips that I've seen some startups be very successful with in terms of navigating the pitch, navigating objectives that VCs may throw your way, and also how to make sure your presentation is tight. I mean, if you guys are already in Angel NV, you guys are doing a great job. You're going to get a lot of tips here at Startup Nevada. So we'll end off with a few of those tips as well. So yeah, very dense topic. And I'm going to go through this pretty quickly because last time I went over time by a lot. So let's start with what is venture capital fundraising. People, I feel like, don't have a full grasp of what VC fundraising is. I feel like a lot of times we see these crazy headlines, especially 2, 3 years ago when interest rates were so low and people were fundraising some crazy, crazy amounts with crazy high valuations. You would hear stories about people with no product, just an idea, raising, $500 million on 3 billion valuation. And I think a lot of times people saw it as easy money. And I'm here to shed light. Not only is it because of the market changes recently, but also it's not really easy money, right? Like those headlines are catchy and that's why people love writing about them, but you never know what happened on the back end, right? You don't know if that person was buddy buddy with a VC, or if that person was the son of the VC, or if that person has been building some really, really strong IP and AI for the last 10 years and just launched, right? So there's a lot of different things to take into account. But when you think about venture capital fundraising, it's not easy money. It's really a promise and a commitment that you're making. When you fundraise from venture capitalists, you are selling shares in your company to investors to fund your growth. So they're looking for very extreme levels of growth. They're looking for somebody that can 10x their return, right? So you're making a deal with them that you can return more than 10x. As a matter of fact, they love the higher the X, the better. The higher the multiple, the more you can grow, the better for them. And obviously now with AI, that can get pretty high. So that's the deal that you're making, right? You're not just taking out a bank loan and saying, hey, I'm going to pay you back with 3% interest. You're telling them you're going to grow this company to crazy, crazy amounts. Now, there's a lot of different types of investors. I like to address this just to like explain the separation a little bit. This goes in order, for the most part, in order of maybe difficulty of you obtaining a capital or sophistication. First is friends and family. People always forget you can raise from your friends and family. Now in Nevada, I think thanks to Jeff and a lot of the work that StartUpNV did, there's a new regulation, I think it's called AB 77, AB 75, where somebody can be considered an accredited investor if they make over 100K a year, or as a couple, they make over 150. So a lot of people can invest in your startup now, and a lot of those are friends and family. A lot of those are individuals or high net worth angels, people with a lot of capital that can just loan you because they like the business, they think it's a good investment, potentially even, oh yeah, there you go. Maggie posted in the chat, Nevada Certified Investor AB 75. So yeah, folks that might just really want to invest in your business, they think it's a really good return, or they might even believe in the mission, right? A lot of times they want to invest in things that support their local ecosystem, et cetera. Third is family offices. Family offices are basically families with really high net worth that put all of their funds in a family office and decide to invest that way. A lot of family offices, they might invest in very traditional things and old school industries like real estate, mining, manufacturing, or they might do tech. And so family offices, I think that's a really, really big one in Nevada. You can find a lot of family offices that are willing to invest in unusual investments like tech, like not necessarily traditional stuff. Next is corporate VCs. Corporate VCs are basically the venture capital arm of a corporation. So think about like Google, they have something called G Ventures, is that what it's called? Yeah. Fidelity, the financial services company, they have a VC arm called F Prime. A lot of these, what we call CVCs, are basically strategic investors. If you're somebody that can potentially sell to that corporation in the future, they might want to fund you now, have you grow, and then once you're big enough, they might want to acquire you to complement their product line. But they could also just want to invest just because they think it's a good investment and it's something that they may never want to acquire. And then finally, what we're focusing on today is traditional VCs. So traditional VCs are the folks that we talked about earlier. They want that 10x plus return. They want to see you grind. They want to see a really good return for their investment, and they want you to prove that you can get that for them. So how do VCs work? Back in the day, I don't know, like when did VCs start? Like 50, 60 years ago, VCs were folks that exited, sold their companies, had, cashed out a few mil and started their own funds. And they were like, I'm going to invest and I'm going to be better than a bank because I can give them really good advice. I can make really strategic introductions for them. I can really help them scale their business more than just giving them capital. But today, the average traditional VC isn't necessarily just funded by the partners. The most common model is through LPs. So LPs are limited partners. And I know we're going to get into like a little bit very detailed on the back end of VCs, but this will go fast, I promise. So LPs are called limited partners. They're folks that are investing in the VC. So they're taking their money and they're putting it in the VC fund. So actually, Angel NV is a really good example, although it's an angel syndicate, but very similar structure in that they take all of these people that give them a little bit of money here and there, and they pool it all together, right? I think Angel NV is probably like $5,000, $10,000 checks. They pool them all together, and at the end, they end up with I think it's 400,000 that they get to invest in one of the startups, which is incredible. And so VCs do something very similar. They raise a ton of money. So let's say they raise from 10 LPs, and those 10 LPs all give them $1 million. Now they have $10 million to go and invest. And they make a decision, they make a deal with those LPs. They say, hey, we're going to return, you guessed it, 10x to you in whatever the time frame is, 8 years, 10 years, depending on the size and the stage of the fund. So they make a deal with their investors. So they have investors as well. So VCs have an obligation to return a certain amount of money to their VCs. So what they do after they collect that 10 mil, whatever it is they go and they find startups to invest in. So they go to you guys and they say, hey, I really like you. I like you. I like you. I like you. I'm going to give you guys all $1 mil each, $2 mil each, whatever it is. They deploy the full fund. So they deploy that full 10 million, and then they just wait. They wait and they wait and they wait until you guys cash out, whether that's some sort of like strategic exit, whether you IPO, and then they get that return, right? So they take the return, and the first thing that they do is they pay back their investors 100%. Now, this is an important distinction to understand. The VCs don't make money unless they return the full, in this situation, let's say it's 10 million, they return the net 10 million, and then any profit on top of the 10 million, they get to keep a percentage, usually 20%. So they don't want to just return the money, right? That is not a good outcome for them. They are working for very little money. Well, some of them get paid a lot of money, but for the most part, they just have their 2% management fees. They're paying themselves 100, 200K salaries. And they could be making more somewhere else in hopes that they're going to 10x the fund, right? Because if they 10x, that can be really lucrative for them. So this gives you a little bit of a framework on like where these VCs are coming from, what they're really, really thinking about when they make these investments. So this is the actual, oh, yep.
It's Maggie. You picked really easy numbers to work with, but why don't you just go through the math? It's a $10 million fund. Okay, if they 10x it, they're getting 100 million. Okay, and then that first thing they're going to do is pay back that 10 million that the investors invested. Right, and so then that leaves 90 million that they then get to split. So they're going to take 20% of that, right, which is 18 million.
Yeah.
18 million. And then they have 18 out of 90. They've got 72 left that then does go back to the investors. So the investors are, right? Did I do the math right in my head?
Yes. I was trying to go back. I was clicking the wrong arrow. Yep, that's exactly it. So these VCs want that 18 million, right? Otherwise, they just spent all these years working for a very low salary. So they want the absolute best outcome for themselves.
Okay, I just wanted to spell it out for them.
Yeah, for sure. And then if you think about it, also the LPs would be really happy, right? Getting like their 10 mil back plus 72 million. That's incredible. You don't see those returns in a lot of different places. And so it's very, very lucrative. And a lot of people, I'm sorry, am I? Okay. Sorry, I'm trying to mute, but I can't figure out where it is. Give me one.
Apparently we're having canine issues. They might be kitty issues. I don't know.
No, it is canine issues. He is a puppy. He just turned 1 last Friday. That's why I had to leave Startup Week early.
Oh, that's right. Good birdie. A birthday.
Yeah. Where did I drop my? Oh, there it is. Okay, let me share again. Sorry, guys. Okay, so yes, we went over how VCs make money. I think that's really important, and we'll keep bringing this up in throughout the presentation because it gives you a really good frame of mind of where these VCs are coming from, right? A lot of times founders will say, oh, this is a really good outcome. But if you think about it in this context, sometimes it's not, right? Sometimes the math doesn't work for these investors and they're looking for something bigger, which is why sometimes you might see another company that doesn't seem as great, but VCs will invest in it because the outcome could be bigger. And it's all about outcomes. And I won't go too far into like the actual math of like how they decide who to invest in, but I think this gives a really good base understanding. Okay, so this is the hierarchy. This is also really important to understand because you have to understand what everybody's job is and how certain decisions are made. So we start with the analyst role that, this is typical hierarchy. A lot of times it's so funny. People think that VCs are like tech startups, and VCs themselves think that they're tech startups. They're not. They're financial services, right? They're basically banks. They're very hierarchical. They have a lot of layers. They are very specific about who does what, and they're not a flat organization. They don't move as fast as startups. And so they're very specific. So if we look at the hierarchy, we start with the analysts. Analysts are usually, to be honest, sales reps. So a lot of analysts at a lot of different funds, what their job is to find all the startups, right? There's a lot of startups that'll be applying to the firm, but how do we find the ones that are really excellent, that are out there doing the thing, the ones we really want to invest in? And that's what the analysts do. So you can imagine for my firm, we're making 120 investments a year. That means we want to look at least 10,000 deals a year. So we have a team of folks that are just scouring LinkedIn, PitchBook, Crunchbase, going to events, going to demo days, just trying to find as many folks as possible that we can talk to. So that is the analyst role. These are like usually entry-level folks, just got out of college, really excited, really eager, want to reach out to and talk to as many founders as possible. The next step up is what's called an associate. So an associate is basically the person that you're going to take the first call with. We'll talk about that a little bit later, but these are basically your gatekeepers. They're the people that you have to get through to start talking to the people with check writing ability. This isn't the case with all funds, but more traditional funds, bigger funds, you'll see this sort of hierarchy very, very clearly. So associates will do that first call. Senior associate, it's basically the same thing, except it's an associate with an MBA. So they might have a little bit more experience. They have an MBA. Because they have that work experience, they might ask more specific questions about your company, whereas the associate will probably have a list of questions that they ask every single company that was written by somebody else on top. And then we have the principal and junior partner. And this is where it starts to get interesting because these are sort of like partner roles. These folks, for the most part, probably have a vote in investment committee. So when it comes time to actually deciding what company they're investing in, they probably get a say. If not a vote, at least they're in the meeting and they're allowed to share their perspective, or they're given the opportunity to share their perspective. So principal is kind of like a junior partner. You can think of this as like partner in training, a managing director, usually have a few of those. The GPs and the managing directors have what's called check writing ability. So these folks have a vote in investment committee. They have a say. They probably had to put money into the fund themselves. A lot of times it's requirement for GPs and MDs to put a certain amount, usually like the minimum investment from an LP, so that they have skin in the game. They can't just be making these decisions without their own money involved. And then the general partner is usually the person that started it. Sometimes some firms call them CEOs. At my firm, we call him the CEO. But he, raised the first few funds. He was a solo partner at the beginning, and then he hired managing directors to join him as well. And then eventually some got promoted to partner. So really, this is the hierarchy that you're going to see all the way from folks that are going out and reaching out to you. The senior associates and associates were people that are most likely to reply to you on LinkedIn, which I always tell people, anything down here, green and light green and under, they're the ones most likely to reply to you on LinkedIn or on email because they're really eager, they're young, they're excited, they're new to the space, and they want to talk to as many founders as possible. And once you get in this space, it's almost impossible to get cold outreach to them. These are the folks that need some sort of warm introduction. You need to know somebody to talk to them. So with an understanding of how VCs make money and this hierarchy, we'll go right into the VC investing process. So, some VCs may not be as structured. Some VCs might not have a very well-defined process, but it's always gonna, especially for the early stages, pre-seed and seed, they need to move a little bit faster. They're smaller check sizes. It usually looks something around these lines. You'll start with an associate call. We talked about this earlier. The analyst will pitch you on LinkedIn and say, hey, I really want to talk to you. Let me set up a call with an associate. This is the person you're going to talk to first. Obviously, if you know a partner, or if you got an introduction to a partner, you might just jump directly to partner call, which is always recommended. That's amazing. You skip a few steps. But if not, if you're cold to the firm or you reached out to an associate or an analyst reached out to you, this is generally where you start. It's the first call with the firm. This associate usually has a preset list of questions on a scorecard. So what that means is they're going to ask you a very specific set of questions. They might dive deeper here and there, but for the most part, it's going to be the same set of questions across the board to all founders. We'll actually show you a scorecard example later on. And then the associate will leave this call and, so the associate, this is their job. They just take calls. That is what they do. At my firm, our associates take between 10 to 12 calls a day. I was there. It was horrible. I never want to do it again. You have to talk to so many founders. If you're a niche firm too, and you only invest in like biotech or certain degenerative diseases, like you're going to hear a lot of the same type of company, and it becomes really, really hard to differentiate the founders from each other. So I say that to emphasize the importance of you standing out. If that means wearing bright colors, or if that means you being really energetic. I told this joke last time I gave this presentation. I knew a founder that would take a shot of espresso, a shot of tequila, and slap himself just to get amped up for the call. And I'm not recommending that, but I'm saying you do what you have to do to be really excitable, to get people really excited about your product and to stand out. Because after a day of 10 to 12 calls, that associate has to go back through and say, okay, who were the founders that I liked? Automatically, obviously, there's some that they're like, no, no, no. And then they have to decide. And then in that time, they have to remember, okay, what was that person about? I don't really remember. Like, let me look through my notes. Oh, I didn't take good notes. Oh, man, you know what? Whatever. Let's just put it to no, right? I'm not saying that's how it always happens, but like you definitely want to be memorable and you want them to be excited about your mission and what you're doing. So sometimes associates do this at the end of the day. Hopefully, if they're a good associate, they are, or at the end of each call, but generally they're not. And so they wait a few days. And so when you're looking at 30 plus founders in 3 days, and that's when the associate decides to go back, it becomes really hard to remember. And so they rely on their notes, maybe their AI note taker, etc. Once they do that, they decide who's moving to the next step. And from those people, they write a memo for each one of those companies. So let's say out of the 30, they pick 3 companies. They go and they write a memo. This is like usually 2 pages. They do a little bit of research and they say, okay, this is a supply chain company. Let me see how the supply chain industry is doing right now. Let me look at the trends. Is this a real problem? If they know somebody in supply chain, usually VC firms have really strong relationships with industry experts. They'll call them up and say, hey, this guy is doing supply chain for QA and automation. What do you think? And get people's perspectives. So they do a lot of research. They write up that memo and then they go to their partner. They go to the partner and they say, hey, I have 3 really cool companies. What do you think? Now, think about it from the associate's perspective. This associate is young, they're eager, they're hungry, they want to move up, they want to be a partner. So they idolize these partners, right? They look up to them. They want them to think that they're smart. They want to impress them. That conversation is really difficult, right? They have to say that this founder is absolutely going to crush it. This is the founder that's going to return our fund. This is the founder that's going to make us all rich. They have to have so much conviction in you. They have to be really excited about what you're doing. They have to really believe in it. And they have to have done the research to back up what they're saying because the partner is going to grill them. And so keep that in mind as you're pitching to these associates, because what you should do is you should leave them obviously with all these things we talked about, excitement, potential, conviction, but also you should send them enough information that they can back themselves up when they're talking to somebody that's very sophisticated, that's been investing for a very long time. Now, once that's done, so let's say they send those 3 over to the partner looks at them and says, okay, all 3 look good. I want to have a call with all 3. If the partner likes it, they'll take the call and then they'll base their questions on the memo that the associate wrote and the risks they believe are associated with the deal. So they'll say, okay, look, I think this is really good, but I don't think you have the right technical ability on the team. What are you doing to get a CTO that can actually build this product? And they're going to grill you until you can give them a really, really, really solid answer. You don't have to, not everything is perfect. Businesses inherently have risk, but you have to be able to justify the risk and also what you're doing to mitigate that risk. They're also on this call assessing you as a founder. So the partner is looking at you and saying, I've met a lot of founders in my time. Do you have the drive? Do you have the tenacity that's going to make it in this sort of field, right? It's really hard running these businesses and we expect a really strong return. When the going gets hard, are you going to make it? If the partner likes you, they take the memo, they take all the information and they take it to something called investment committee. I kind of touched on this a little bit earlier. Investment committee is when all the partners or anybody Sometimes, I mean, in my firm, we let the associate that brought the deal get on the call because obviously they met the founder initially, they wrote up the memo, they did a little bit of research. So they sit on the call, but they don't get a vote. Just the partners get a vote. And so you go to investment committee and it could be like 3, 4, 5 partners. If it's one partner, great, you skip the step, they like you. But if it's 3 or 4 of them, they're going to sit down and they're going to spend an hour a week talking about all the deals. Now think about it. If there's 4 or 5 partners, each one of them has 3, 4 deals. That's a lot of companies to talk about in just 1 hour. I mean, to be fair, we usually go over. Usually ends up being like 2 hours. We should just change the meeting. But it's a lot to cover, and it's a lot of conviction to give people to vote money that they personally invested in, money that they're responsible for from their LPs. So the decision-making process has to be quick. So your company has to stand out. So again, it's kind of a similar process from the associate pitching to the partner, but in this case, the partner's doing the same thing to his or her group of partners. Oh, I saw you're asking questions, Faye. Yeah, if you have any questions, feel free to jump in. So every partner presents their deal and then they vote on it. So this is kind of like that moment of like, are you getting the investment or are you not getting the investment? Apart from that, one thing I like to call out is that most firms have a veto policy. So at my firm in particular, and a lot of other firms that I've spoken to, every partner usually has 1 veto per cycle, whatever their cycle is. Our cycle is every 6 months. So every 6 months, our partners have a veto, so 2 a year. And what that means is if they met you and they absolutely love you and they think you're going to make it, maybe it's not the best idea today, maybe it needs refinement, but they just think you're that type of founder that they need to invest in, they can veto the vote. So if every other partner says no, or if you don't get majority, whatever the case is, they can veto that vote and say, I really believe in this person. I think this is my wild card. I think they're going to make it. So even if other partners don't believe in you, this partner can push you through. So it's important to build that really, really personal relationship, right? I love it when like I hear founders are getting on a text basis with the partner. That means they really like you. They can text you while they're investment committee. They can just text you and be like, hey, I'm getting this question. What should I say? Oh, I got a question. How often do they get the veto? So it depends on the firm. So my firm in particular, we get 2 vetoes a year. So 1 every 6 months, just because we're predominantly an accelerator and we have 2 accelerators a year. So that's for the accelerator cycle. For our seed fund that's bigger, we get 1, I think. So yeah, I know also like if the partners are really close, obviously, sometimes they'll just vote in your favor because, they trust you. Like to be a partner, you have to trust each other really well. So, but this is like a formal process where they can say, okay, I want this person in, even if everybody else says it's a bad business. How many are accepted to the accelerator? So we run a B2B SaaS accelerator. Our accelerator, out of the 120 investments we make a year, 90 go into the accelerator a year. We used to be cohort based, but we recently switched and we're actually now on a rolling basis. So you can apply at any time and we'll consider you at any time. Yeah. Okay. So you go to investment committee, let's say you get a yes, how exciting. The next step is due diligence. Everybody hates this. Nobody wants to do due diligence. They think it's whatever, especially when you're pre-revenue. They're like, what are they diligencing? There's not even any finances or revenue, but this is so, so, so critical. I see so many deals slip through the cracks here because of something that happened earlier on that really could have been mitigated. Due diligence can be technical. They can have a developer look through your code or your tech stack and make sure that it's tight. They can do a demo of your product. It can be financial. Obviously, they'll want the base stuff like, are you incorporated? Where are you incorporated? Who are your employees? Your deck, your plans, all that good stuff. I gave an example when I talk about this. I had a founder that was an excellent founder. He had an excellent product. Honestly, we were so excited about the company. And we're a pre-seed accelerator. And at the time, we were accepting a lot of pre-revenue companies. So I think we would have accepted him even if he didn't have any revenue. But he got on the call with me. This was back when I was an associate. And he said that he had signed contracts and they paid upfront. And so he got $100,000 already. Super incredible, right? Getting $100,000 first year of business. I was like, wow, not only is it an amazing company, amazing founder, also has all this amazing booked revenue. Go to the partner stage, partners love him, go to investment committee, everybody loves him, get to due diligence. Guess what? He did not have $100,000 in the bank. He didn't even have signed contracts. It was an LOI, a letter of intent. And I just wonder why. Like, I was like, how did you not think that was going to be caught in due diligence? Now you wasted everybody's time, all these partners, the partner that pushed you through, me. And so what's going to happen is every single time a VC or somebody else sees that we're connected to him on LinkedIn, they call us and they ask us, what do you guys think about this founder? We tell them the story. We tell them he lied during due diligence. He ended up not raising. I'm pretty sure he shut down the company. But just a great example of like, I'm sure it wasn't malicious. I'm sure he just was really excited and he thought he was going to get the money. So he slipped and said, you know, I do have it booked. And then he just kept saying that. And then it was too late. I don't know. It could be a lot of different things, but just stressing the emphasis of diligence. Sometimes the thing that you're exaggerating might not have even been necessary. They would have invested in you anyways. So definitely be good about your due diligence. Okay. Apart from that, they don't just check, obviously, that you're lying. It's not just that. They also just do a lot more research in the industry. So there are some deals that slip through the cracks, sadly, because, you know, we found out that in this industry, this isn't a very popular thing. Maybe we interviewed a few people that would be potential customers. They all said they wouldn't use the product. It could be a lot of different things, but this is really where they're solidifying their decision. And then if that goes well, you get the money in your bank. Woohoo, it's so fun. Oh my God, I know when founders send me that text, they're like, money hit the account. And they send a little screenshot of like the 7 figures that they have in their bank. They're so excited. I just love that. I think that's so awesome. And yeah, from then on, you don't really go through this process unless they have a board seat. And that's a whole other story. So that is the VC investing process. Now, a lot of what I'm going to focus on next is going to be this call. And the reason for that is because that's where the majority of people slip up. That's the hardest one because you don't understand how the entire process works. A partner call is obviously very hard as well, investment committee as well, but I'm going to be focusing on this stage. Really quick, I got a question. Is the VC process you described typically a 3 or 4 month process? Yeah, that's a really good question. So I'm talking across the board for pre-seed and seed. VCs vary in the time that they get back to people. To be frank, the faster they get back to you, the more excited they are about you, right? When we think about this investment committee call and how many companies they have to talk about in such a short period of time, what they do is they bump up the companies that are most important to them, the companies that they think might be stolen by competing VCs. So the fastest deal we've closed is 1 week. 1 week from associate call to investment. The associate got on the call with them. The founder had exited 3 companies, amazing pedigree, amazing resume, very relevant to what he was trying to build. Moved it to partner call. The second day, the partner call did an ad hoc investment committee because I was so excited about this founder. And then we did diligence really quickly, like it was all hands on deck and made the investment. It was so incredible. And I wish we could move like that all the time, but definitely we were exhausted that week and put a lot of other people on the back burner. So yeah, VC processes, I would say, traditionally, I would say it's like closer to 4 months, but honestly, in this market, it's a lot tougher. I would expect it to last 6 months. Yeah, even for the early stages. Oh wait, no, sorry, you're asking just about this process. This process for pre-seed and seed shouldn't last more than 2 months. I'm saying 6 months in terms of like you going out to raise, like how much time you should allocate to that. It's tough to build momentum and get the intros at the beginning, right? So that takes like 6 months. But yeah, this process shouldn't take more than 2 months. We internally try to do it in less than a month. Like that's our goal, 4 weeks. Do we always hit that? No. But that's our goal and that's what we try to stick to. And the closer funds are to the 1 month mark, the more founder friendly they're considered. Obviously, some funds are very litigious. Okay, the fun part. This is the scorecard. So what do VCs look for? We mentioned that the associate call, a lot of times it's a predefined list of questions. I actually helped create some of this for my firm. It was a fun project because we get to decide like, okay, what are we asking? What's the information that we really need up front that can't just be put into an application, right? Because there's the application phase. So when it comes to early stage investing, I always say there's 2 main buckets. There's only 2 things VCs are looking to validate, a lot of sub points, but the 2 main points are market. Is this a good market? Does it make sense? Is it big enough? Is it lucrative? Profit margins high? And can this team execute? Is this the right team to build? Do they have the right experience? Can they actually make it happen? If you take those two buckets and you get a yes across the board, you are probably going to have a very successful fundraise. But that's usually not the case for a lot of founders. So I'm going to run through these questions. You don't have to answer yes to a lot of these questions, but the more yeses you have, the more likely you'll have a successful fundraise. So let's get into it. We'll start with the market. First is the size. I'm sure you guys have heard this. You probably already heard this at Angel NV a lot. Venture scale. What does that mean, right? Venture capitalists are looking for venture scale. They don't want to invest in, a small mom and pop car wash, right? That doesn't make sense to return all that money to their LPs. They're looking for really, really, really big exits, and that can only happen in really, really, really big markets. An example of something that isn't that big, I met a founder once. He was selling, I think it was like some sort of scheduling app for workout trainers. Yeah. So trainers to be able to schedule with clients and book, right? And so the app was supposed to be $5 a month. And he was pitching that. And I was like, this is not a big enough market. Like, if you think about it, $5 a month, multiply that by 12, you get 60 a year. How many personal trainers are there in the US? I think I looked it up and there's only like 4,000, I don't know, something really small, 4,000 personal trainers. If each one of them is paying $60 a year, what does that get you, right? A few mil, not worth it for the outcomes that we're looking for. So when you think about, and I think Startup Nevada does a really good job with their TAM, SAM, SOM, their market sizing. I think Maggie teaches it actually. They do a really good job of walking you guys through this and figuring out what venture scale is. So focus on that and make sure it is venture scale. Okay, so that's number one. Two is timing. Why now? A lot of folks don't take this into account, and I think it's one of the most important things. Why is this business going to be successful now? I love sharing this, but two people invented the radio on two different continents at the exact same time. What does that mean? I guarantee you somebody has thought of your business idea before you. Like, unless you're that really minuscule 0.00001%, somebody that thought of something absolutely brand new, I guarantee you somebody thought about something you're thinking about in one way, shape, or form here or somewhere else. And either it didn't work or it did work, in which case they're an incumbent, right? So why now? What are the trends that you're following? I love seeing decks where they come to me and they say, hey, I'm just making this up, but like, let's say we're an influencer platform that's going to match influencers with small businesses that are mission driven. And the reason for that is because influencer sales are growing exponentially. Younger generations are trusting influencers more and more. They're on social media more and more. And also they care about mission driven companies. That is so many trends that you're following that I'm like, oh my God, we're at the precipice of investing in something incredible. And that's the kind of feeling you want to give your VCs, right? On the other side, if you came and said, hey, I want to build a technology for malls, I'd have a lot of questions. Probably not the right time. So that's really important. And it's also important to emphasize that. Why now? Nobody should have to ask. You should be able to explain that from the beginning. The reason this is important now is because of X, Y, and Z. Then it's competition. I'm sure you guys do this all the time. Anybody starts a business does a comprehensive competitor analysis, but check if there's already an incumbent, right? Are there any barriers to entry? Is the incumbent Google? If it is, I don't know if you want to compete against them, right? But if the incumbent is some slow moving old school industry, then yeah, maybe it's ripe for disruption. So competition is important. You don't want no competition because maybe that shows that it's not a big market and the timing maybe isn't good, but you want a healthy dose of competition that proves that this is a good market, or a market ready for disruption because it's so outdated and moving slow. Next is adoption. How likely will the market respond? How likely will your clients actually sign up with you and adopt your technology? Even if it's a slow moving market and you're trying to disrupt it, a good example was like legal tech. Lawyers are really, really, really slow to adopt new technology. They've been running it for a very long time. It took them a long time to become a partner at a law firm. There's a lot of industries like that where they're just slow to adopt. That doesn't mean I don't invest in legal tech at all. I've actually made a lot of investments in legal tech, but I want you to convince me that your technology is so great and so revolutionary that even slow adopters will want to sign up. Next is need. Is this solving a real problem? I should move this up. This is so important. This is like the number one most important thing. I started this presentation by talking about this. You need to understand the problem. Do your customers, excuse me, do your customers have a really specific problem? Is the pain point so high that they're willing to pay a lot of money to get rid of it by paying for your solution? We always talk in VC about the vitamin versus the pill. Is your company a vitamin? Is it really nice to have? Like, oh, okay, once in a while I'll take this turmeric pill because they say it's good for my joints or whatever. Or is your company a pill? Is it an antibiotic? Is it a Tylenol? Is it solving an immediate pain point? You definitely want to be on the pill side. Is it financially, is it capital intensive? This is, really big deal for a lot of biotech companies that have to get FDA approval, things that move really slow. You got to pay a lot of money to government. You got to pay a lot of money for testing and all that stuff. If it's really capital intensive, some VCs look away from that. Biotech in particular, like we don't make those investments because we just don't understand the FDA cycle. We don't understand that approval. And so we promised earlier returns to our LPs, but there are actually firms that specifically focus on this because they see how lucrative it is and their timelines are longer. And honestly, they can help you get approval. So they're a very good strategic choice to take capital from. And how much more money you'll need to raise. If it's something that's going to require more and more money, it might not be something they're interested in. It depends on the appetite of the investor. And lastly, legal. Is it a litigious market? Are you going to get sued a lot? Is this going to be a problem for the VCs? Always things that they consider. So that is the market risks assessment. These are some of the risks. This is not a comprehensive list, but this is pretty close to our scorecard at my firm. And so definitely go through and see if you have a positive check mark near all these questions. If yes, you're probably looking really good on the market size. On the other hand, we have the execution and the team risks. So we start with the experience, right? Is this the right team? Do they have the right experience? This is really hard, obviously. Like, no, chances are nobody has the perfect experience for something, but think about it as comparison, right? We're talking about, again, for a firm like mine that's very high volume, we're talking about looking at thousands and thousands of startups a year. Do you have the best experience for your industry compared to all these other founders? Really good experience. We love something called the founder trifecta. The founder trifecta is basically having 3 founders. One of them has deep domain expertise. This is the person that spent 15, 20, 25 years in this very specific industry. If you're selling, for example, like we had a startup that had a founder that had 20 years experience in drones. And it's like, what? Were drones even around 20 years ago? Like he was there from the beginning. So like amazing experience, knows everybody in that field, can sell very quickly because already has that connections and understands the need and the pain points very, very well. That person is instrumental to a company. The second person is the technical founder. This is usually the CTO, but if you're a hardware company, it could be like, the engineer that's producing the thing. In my experience, obviously, I do more software. So we're always looking for a CTO that has over 10, 20 years experience building that particular tech, right? If you find a CTO that has historically built AR, VR solutions and is now trying to build a fintech, it might be a really far stretch. We're looking for somebody that knows how to build this and knows how to build a team around it. So that's the second person. And then the third person is the business operator. You want somebody that's going to be a COO that's going to come in. They're going to easily be able to hire a team, scale a team, build out the operations, find offices, build out a team, drive performance, do all the stuff that you need to run a business without blinking an eye, right? This is somebody that historically has scaled 2 to 3 companies in the past or hopefully exited and is really good at it and can do it with their eyes closed. If you have those 3 folks on your team, that would be the perfect experience. Now, when we find that, we're like, oh my God, it's like a unicorn. If you don't have that, and if you don't have a lot of experience as a CEO, that is okay, right? There are still people, like if you look at Mark Zuckerberg, right? Like, what was he, like 19 years old, building some social app? He was really good at building a team around him. He recognized what he was not good at, and he got people that could supplement his strengths. Next is driven and tenacious. I think this is self-explanatory, but obviously running a business is incredibly, incredibly hard. We're running a venture-backed business where the expectation of you delivering returns is so high. They're looking for somebody that's very driven, tenacious, and that's not going to give up when the going gets hard, right? When COVID hit, a lot of our founders quit. And I get it. All of their clients churned. They couldn't pay their employees. They had to do layoffs. It was a really, really, really rough time. But we're looking for those founders that, you know, even in the roughest of times can, if not survive, then pivot and actually get a good outcome out of it, which I've seen a lot of during COVID, which was incredible. Okay, I'm gonna stop for a question really quick. Since AI is hot now, do you agree founders need to be able to clearly explain to investors what AI tools they're using, how they're using them, and need to explain where is the data being sourced that the AI tools use? Founders, in my opinion, should avoid putting evaluation on the AI tools themselves. Let me see if I understood the question correctly. So you want to know if VCs want to know if you're using ChatGPT? No, I know. There's a lot of AI tools out there. It depends. Every single company whose deck I get today, if I control F and search AI, it's going to be somewhere in there. My opinion is if you are not building the AI, do not mention it. If this is not your proprietary artificial intelligence that you built and you have a CTO that is an expert in AI, no one cares, right? Everyone assumes we're all going to be using it. Every investor assumes you're using AI today, and you should be, right? That would be the equivalent of me asking you if you're using Excel 10 years ago. Like the assumption is yes, your financial modeling should definitely be on Excel, right? So it's just a tool. I don't think you have to mention it unless it's like a core component of your business. Some people feel the need to bring it up if like you're using, like for example, if you're fintech and you're using AI to be able to hedge your risks better, then I think that's a big enough portion that you should bring it up. But if you're just using it to like support your content or help you build out your business, that's just an expectation. Let me know if that answered the question. If not, I can dive deeper. Okay. Next is self-awareness. This is really, really big. A lot of founders feel like they have to go into the VC pitch and just be blindly confident. I agree, you should be very confident, but I don't think you should be blindly confident, and definitely don't be defensive. I don't know if you guys have seen a lot of pitches, but even sometimes like at the Startup Vegas pitches or Startup Nevada, you see a lot of founders get asked questions and they don't like the question and they start getting really defensive. Don't do that. Don't do that. Even if you don't like the VC, even if they're rubbing you the wrong way, whatever you do, do not get defensive. Have that self-awareness and showcase that you're very, very confident in your strategy. You know, you're not a pushover. You believe in what you're building, but listen to their questions deeply and answer it, even if it might seem like they're leading you on somewhere. I know sometimes founders get really frustrated when an investor says something like, you know, something that's a little bit leading, like, well, don't you think Google can build this in a day? And then the founder will be like, no, they can't. This is why. And it's like, okay, relax, take a breath. Explain why not, right? Very calm, cool, and collected. Self-awareness also means understanding your weaknesses. So I see a lot of pitches today where they don't have CTOs on the team. That's okay. CTOs are in very high demand. Most CTOs are going fractional now because they can and they can support a lot of different teams. For a deep tech company to be successful, they need to have a CTO on staff. And so for pre-seed, we don't really care because we can help you find a CTO, right? But I ask the question, you say, hey, how do you plan on building your tech without a CTO? And sometimes they get defensive. Well, I have a really good fractional CTO. This is going to be fine. It's going to be fine. I'm like, okay. If you had just said, hey, this is good for now, but once we scale to a level where we need a full-time CTO, that's going to be my primary focus, that would have been good enough for me. But then I write them off as not self-aware, right? And so you never want to be that. So really take a moment to reflect and just assume everybody's asking out of curiosity and not malintent. Next is coachable. On the same vein as self-awareness, coachability is basically VCs are not just giving you capital, right? They're giving you introductions, they're introducing you to their network, they're giving you strategic guidance. If they sit on your board, they're going to be very involved in the business. And so they want to know that you can take advice well. That does not mean, again, that you're a pushover and you just take everything they say to heart and you just build a business based on them. No, the assumption is that you're the founder, you're working in the day-to-day, you understand this business better than anybody else. Better than anybody else. The VCs don't think they're smarter, better at making decisions. They're just giving an outsider perspective, which sometimes is great. And they want to see that you're willing to take it with an open mind. Again, not being defensible, but taking it and saying, yep, you know what, that's interesting. Maybe I'll try that as an experiment. And next time you talk to them in a month, in a quarter, whatever, say, hey, thanks for the advice. I tried it. Didn't really work out, but we tried this other thing and it is working. So thank you. Keep the advice coming, right? Super, coachable, took the advice, maybe tried it a little bit, maybe didn't. But they listen, they take advice, and definitely not defensive. Technical, I feel like I've brought this up a lot, but I just see it so often that I feel like it has to be addressed. Do you have the right technical ability to build this product? And if not, again, that is okay as long as you have a plan to be able to bring that expertise in-house. You cannot build the fastest growing tech company without owning your tech completely. And at this early stages, it's okay to have a dev shop or a fractional or whatever, but eventually you have to have a plan to bring that indoors. And then finally, motivational. Will smart people want to work for you? Would I work for you? That's actually one of the things that I added to our sheet is like, if these really, motivated young people on our team are doing these calls and they're not so inspired by this founder that they would quit their cushy job to go work for them, then that founder is not going to be able to get smart people leaving their jobs to work for them. You have to be so good that you can talk to an engineer at Google, at Netflix, at whatever, and say, listen, I know you're making bank right now. I know you're making 500, 600K a year. Come work for me for 80K a year, and we're going to change the world. And if I don't think you can do that, then, that's a little tick of like, oh, I don't know if they can build the best team. So you definitely want to showcase that on your calls as well. Okay, so that is the scorecard. Oh, let me go back. In case anybody missed it, this is the full scorecard. I would say I'm going to take 5 seconds now, take a screenshot, take a photo with your phone. These questions are so important. These are the base questions you're going to get from any VC. If you're not already addressing it in your pitch, they're going to ask you about it. Make sure you have a really strong answer for it. Make sure that, again, you're coming off as likable, that they want to vouch for you, that they have that conviction in you. Take a screenshot now, take a photo now. I'll come back to this later in case anybody misses it. Yeah, in case anybody misses it. I'll stop here really quick. Does anybody have any questions? Because that was a lot of information and I'm gonna take a break to drink some water. If anybody has questions, feel free to drop it in the chat. Sorry, I know my voice is breaking. I lost my voice last week. I was sick. That's why I didn't make it to some of the startup week events. Oh, trying to recover. Okay, it looks like we don't have any questions. Again, feel free to drop it in as we're going. But this is your scorecard. This is the criteria. These are the most important factors when VCs are looking at you. I want to caveat here. I am a B2B SaaS investor. You will notice a lot of this is about software. If you're a hardware company, they will probably have questions about production, about how you're going to figure out supply chain, how you're going to distribute. That is not my area of expertise, so I haven't included it. But I think if you just take a moment and reflect on VCs, or also just have a few calls, write down all the questions that they ask and make sure that you have really tight answer and weave nicely into your pitch and story. Okay, so you do this call, they love you, whatever. Let's go into objections. So objections sometimes are given during the call and sometimes they're given afterwards during email. I am not going to sit here and write out all your objections, but I will say I recommend this to every single founder that is fundraising. As you are going through your fundraise, you should have an objections sheet. I like it on Google Sheets. I share it with everybody on my team, and I write out every single objection, whether it's a question that was worded in, as an objective. So, when people ask, do you really think you're going to scale that fast? Write that down. What you want to do is after the call, after some time, you want to sit there and reflect on that question and that objection and say, what did they really mean by that? What did I say that made them think that's not possible? And what can I say in future calls to make them believe it? Or what can I say back to this VC that I want to invest in me? So these are the three most common objections you'll get from any VC at the early stages. First is you are too early. You don't have enough traction, you don't have enough revenue, you're just too early. For the most part, that's not true. There might be a few cases where you are too early, but for a pre-seed fund, most of the time they are investing pre-revenue. Maybe not in this market, we're going a little bit post-revenue. But what do they actually mean? Because at the end of the day, if they really like you, like we said, you could have been their wild card investment. So what does it mean when you're too early? One is they might not believe you're the right team to make this happen. It's really, really tough. If your market's not big enough, it's really easy for an investor to say, hey, your market's not big enough. It's not venture scale, right? They can say that easy. But it's really hard to say, I don't think you're the right founder to build this. And so this takes a lot of self-awareness to reflect and say, is it that it's too early? Or is it that they don't think my team is strong enough, right? Is it that maybe they don't like the market? Is it usually too early is a cop-out answer. I'll say that. Like 60% of the time, it's not too early. There's just something else they don't like, and that's just an easy answer they can give you. If they do say this to you, my recommendation is to ask them what metrics they want to see by when, and then make sure you hit them up and follow it up. So basically, if they say, oh, you're too early, say, okay, I'm too early. In what ways am I too early? Is it that I don't have enough revenue? Is it that I don't have enough customers? Is it that I don't have enough beta users? Is it that X, Y, or Z? Whatever the reason is, ask them what metric do you want to see? And where do you want that point to fall by when? So if it means, okay, I want to see you get 50K ARR in 6 months, then that's your new target. And then you make sure you save that, you remember that, and you follow up with them and say, hey, remember 6 months ago when you said I was too early? Well, guess what? I just hit your metrics. Now what? It becomes really hard for them to go back on that. So sometimes they just won't reply when you ask them. And if they don't reply, that means it's something else. But if they do reply, then maybe they will invest in you. Let me take a quick pause. What about tar pit ideas? Oh, I don't know what that is, Maggie. Can you elaborate on tar pit ideas?
Yes, tar pit ideas. Tar pits collected dinosaurs, right? Because they're black and shiny, they reflect the sky, they look like water. The animals go to it because they think they're going to drink water. And then they walk in because then when they first taste it, it doesn't taste like water. So they walk into it, they get trapped and they can't get out. So tar pit ideas are attractive ideas that you can't get out of. So they're ideas like they're problems. They're usually consumer facing problems that nobody has been able to crack because it's just too complicated or it's just too varied a problem that there is not one solution.
Yeah, this is like
those are tar pits.
Like recruiting, like finding a way to like match the
HR.
right.
I see a lot of HR. I see a lot of, I think you even mentioned scheduling coaches for
Productivity
athletes.
apps.
And then they want to do it with youth athletes because there are so many of them. But the youth athlete is not the customer and they're not paying the bill. It's the parents.
Yeah.
So those types of ideas where it seems like it should be easier than it is.
Yeah, you see a lot of that. I don't know how founders can avoid it. I think it's just conversations with investors and getting people's feedback. I see a lot of like these ideas, like when our application opens up for a forum, you see a lot of recruiting. We're obviously B2B, so we don't see a lot of the consumer facing stuff. Right. But on the B2B side, the HR tech is crazy. It's like, I think 40% of our applications are HR tech. And I think it's because people are so frustrated from applying for jobs that they want to find solutions for them. And if you do have a real solution, that's great. If you have a go-to-market strategy that is strong and a way to capture people, because I think that's where they slip up. Say, I'm just going to be the next Indeed. Okay, how are we going to get people on there? I'm going to advertise on Google. You can't do that anymore. Everyone's doing that. You're going to fight for the same team, right? So I think it's a matter of actually thinking through the idea and honestly just pivoting when the time comes to it. And that goes back to the coachability and the tenacity of like, if you're really serious about this business, you really want to run this business, take that feedback back and pivot your idea so that it's something that's really tangible, that there's low barriers to entry, but also not that many competition and a way that you can actually acquire customers.
I agree. It's you got to talk to and listen to potential customers and understand who's going to pay the bill. Because, yeah, sure, every person who's looking for a job wants an easier way to do it. But are they going to pay for it, or is it going to be the recruiters or the HR staff in the company?
Oh man, Maggie, I could talk about this forever because you just brought up like when people say product-led growth, I get so frustrated because everybody thinks product-led growth means not selling. It means letting the end user use it, like these like productivity tools like Asana, Trello. Everybody saw these good examples, and then all of a sudden everybody thinks that they can capture the end user and then convince the actual buyer, who's probably the CEO or their boss, to pay for it. And I'm like, this is a bad idea. Like product-led growth, everyone needs to stop. There's a world for it. It's cool, whatever, but it does not mean you don't have to sell. People try to avoid selling at all costs. But anyways, I won't go down this rabbit hole. Oh, there's another question.
And
For a
Mike put his question in.
Oh yeah. For a company that's pre-revenue, how valuable is it that the founder was able to pull talent from a well-known company? Um, Very valuable. Yeah, absolutely. I've seen founders that are early, like pre-revenue, that have convinced engineers from like the FANG, the Facebook, Apple, Google companies. And that's always so incredibly impressive. I've also seen founders that can't necessarily pull them. What they'll do is they'll say, once I raise and I'm able to pay them at least a living wage, then they've signed on. They said that they'll sign on, which is also a really good show of faith, because I'm like, I totally understand if not everybody can take a zero salary, right, while you fundraise. So you can also put that in your deck. I've seen that where it's like current team, just the CEO that's raising, and then team joining once fundraise complete, and then they'll have like engineers and really good talent from these good companies. So that's really, really good. That shows a lot about you and your ability to motivate and inspire people. I will caveat here, advisors have gotten a little bit crazy. There's been so many companies that will have a conversation with somebody once and then they'll add them to their deck as an advisor. So now, this is my personal opinion, I don't take advisors that seriously unless you say I have a signed contract with them, I've given them 1%, and I meet with them 2 hours a month or whatever, and you can showcase that they're really committed. Even better if that advisor invested in your company. It doesn't have to be $100,000 or anything crazy. If they gave you 2, 3, 5 grand, that shows me that they have enough faith in you that they're willing to give you a tiny investments for the 1% that you give them as an advisor. So those are really good ways to showcase that you can bring a really solid team together, and supplement your skill set wherever your weaknesses are. So this is the too early objective, the too early objection. You're going to see this a lot. Again, it can mean so many different things. You definitely want to have self-awareness and understand it, but don't drive yourself crazy. I've seen founders where they're like, everybody says it's too early. What does that mean? And I'm like, listen, sometimes they're just lazy and this is the easiest out for them. Sometimes you can't dig too far into it, right? You have to have that balance of reflection and letting go. Next is the market is too small. This is probably a legitimate claim, because if they say this, they're actually going to back it up with math. This means they don't think that they're going to get a good return from this investment. It doesn't mean it's a bad business. It might just mean it's not good for this VC or for VCs in general. And maybe you want to look for capital elsewhere, right? I think, a lot of the most profitable businesses aren't venture scale. Like I run a consultancy. That is not, no VC is going to give me cash, right? But really high margins, we do really well. A lot of small businesses are the same way. So they just don't think that their return is gonna be good on that investment. So if you really think you are venture scale, I would push back, right? Ask them why they think that is, and have them explain their math. And then what you can do, which is a really good strategy, I've met founders that what they'll do is they'll talk about their beachhead market. If you're not familiar with the term beachhead market is basically the market that you're capturing now before you expand to other markets. So I'm just going to give this example, even though we just said it was like not the best business, but scheduling, right? The founder that I said he was selling to trainers for scheduling. If he had told me, okay, this is just for, well, I wouldn't have done it because of scheduling, but if he had said, I'm doing trainers now because it's low hanging fruit and I know they're willing to pay and I can get a lot of revenue and traction. But then once I validate with that use case, I'm going to share with other things. I'm going to go into other wellness, like spas and gyms and boutique studios. And then past that, I'm going to go into doctor's offices, and any place that they need scheduling, right? If you can prove that your market right now is just the beachhead, and that's going to get you, let's say that's like $100 million market, and that's too small for a lot of VCs. But then you say, hey, I also have this whole other market that I'm planning on tackling, and that all combined is worth $1 trillion. Then it starts to become so much more lucrative because the market is bigger. It's just that you're starting with this really small piece, which is what we call a beachhead. Again, Startup Nevada does a really good job of doing the TAM Samsung and the market sizing. So you'll do it there and you'll start to see what isn't a good market. I've seen a lot of people pivot here where they're like, oh, I don't want to sell to X, Y, or Z. That's not a big enough market at all. I have to figure out something else. And then last and worst case scenario, silence. They just don't get back to you. Look, fundraising is a sales process. You got to hunt them down. Don't take silence for an answer. In sales, we say the second best answer is no, right? Obviously, yes is great, but the second best one is no. Worst case scenario is you get a maybe, they drag you along, they don't get back to you. Be persistent and follow up with them. Be professional, I've gotten emails where founders are like, you told me you would get back to me in 7 days. It's been 10 days. What is wrong with you? And I'm like, whoa, is that how you're acting around clients? Like, that is not cool. So you want to show that you're professional. You want to show that you're persistent. You want to show them that this is how they're going to hunt down their clients. I personally have missed deals. It happens when you're making hundreds of investments a year. It's just going to slip through the cracks, whether when it's being passed on to someone or it falls in somebody's email. Just assume that they're not ghosting you on purpose and follow up with them. I always say do up to 8 follow-ups. If you follow up 8 times and they're still ignoring you, then they're ignoring you on purpose. But I can guarantee if you do 8 follow-ups, 90% of people will reply to you. They'll be like, I need this person to stop emailing me. And that's okay. They should let you know. Get that no, and get the answer why, because I am a huge proponent in that VCs need to start telling people why they're not investing in them. Since we're talking about VCs and how they think, you also have to understand the political climate of VCs, right? So venture capitalists, they are trying to make a name for themselves. They want to be known as the best investor. They want to invest in the next Facebook, the next Apple, the next whatever. And so sometimes they're silent because they don't want to say no. And 10 years later, you become the next unicorn and you go on X or Twitter or whatever, and you share that they said no for these reasons and they were absolutely wrong. They're trying to save face, right? I am really against that. I know Maggie is too. We believe that VCs should be giving people feedback. And so if they give you a no, just write a very polite professional email back and say, hey, thank you so much. I really appreciate you getting back to me. It's really hard out here. People are ghosting left and right. I would love it if you could just give me a really quick 2-minute answer as to why you said no. That would really help me out as a founder. I've gotten that email from plenty of founders, and I will spend 30 minutes replying to that email because I think it is just so well written. I think it's so polite. And I know that this person is really out there trying to make their business happen. And so generally VCs will be very responsive to that. Just, don't write it when you're mad, right after you got the no, because I've gotten those emails and I will not respond if somebody's being rude. Okay, we have a question. If we had a no from some people, can we go back to them? And secondly, what are the intervals of follow-up where you can easily cross the line from follow-up to being creepy? Okay, great question. So few rules. What was the first question? No, someone. Yes, you can always go back to people. So if somebody said no to you, first, what I just said, which is like send them that email right away, say, thank you so much. I really appreciate you giving me a no. A lot of people have just not gotten back to me. I would love it if you took, just 1 or 2 minutes, really quick, give me the quick and dirty answer of why you said no. It would really help me out in my business and in planning my future. Really short and sweet, really nice, just kind of like, being very open and transparent about why you want this feedback. Hopefully they'll respond. If not, you don't have to follow up on that email. But if they're not responding because they're not giving you an answer on investment, I think you should follow up every week. So maybe Wednesdays is your day. I actually do that for my business with my prospects. Wednesdays from 2 to 3, that is my follow-up hour. I go through my CRM, I check everybody that I need to follow up with, and I send them emails. For investors, you can just quick email, hey, following up, would love to get an answer. You can also try to push a little bit of momentum. I would be cautious with this, but you could say stuff like, hey, I'm talking to a few other investors. We're starting a party round, or we're looking for more investors to come in. Would love to know if you're excited by this, right? Something like that. That's different every week, and you can do that 6, 7, 8 times. If you don't get an answer, just shut it down. It's not worth it. I'll say 2. Sorry, I'll say 6 times. I usually, for sales, for prospects, 8 to 10 is a good answer, because you're really trying to get them, because they're gonna be a client. But for VCs, I would stop at 6. Other than that, it would be a little bit much. But honestly, if you're polite and you're professional, persistence is never seen as a negative thing. They might be annoyed, but they know you're going to get it done. And that might change their mind. They might be like, oh, I didn't know they had it in them. They seem really, really driven. Yeah, I think that's it. Don't go on their LinkedIn and try to message them on LinkedIn and on Twitter. I would say please avoid that. If you have their email, just do it on email or wherever you're communicating. If you were on LinkedIn, follow up on LinkedIn every week. If you're on Twitter, follow up on Twitter every week, but don't go across platforms and try to like harass them everywhere. Yeah, awesome. Okay, so these are the 3 most standard objectives. Last slide, I told you guys this was going to be dense, is a recommended exercise. So what I think you guys should do, and what I do for all the founders that go through our programs, I built our accelerator program at Forum. We make them go through the list. We actually send them the list, and we make them go through and answer about themselves honestly and brutally. So remember the question about experience. Does your team have the right experience? I actually want you to go and type out or write out an answer and say, you know what? We have 2 really solid engineers, but they don't have XYZ experience. We could really use an asset on that end. Our founders are really strong, 20 years combined experience in X industry, but we don't have any brand names, which we know is lacking. And maybe we should look for somebody that has a really big brand name to look good on the deck. Really go through and be honest and brutal, and be very, very self-aware about you and your business. And it's going to help you so, so, so much. One of the things I recommend is, if you can't do it for yourself, sometimes it's hard to like reflect in that way. Get a friend that knows a little bit about your industry, like a really good friend, and just ask them to rip you apart. Like, tell them that if you leave feeling good, they didn't do their job. And see, I have friends that would love to do that, and I have done that with them for different businesses. And it's a fun exercise, right? You're not going to be hurt. You know, they're one of your best friends. You know, they're in it to better you. Maybe it's a spouse that does it. Maybe it's someone else. Just make sure you go through it. And what I'll do is I'll actually go back now to that list of questions and stop right here. For anybody that didn't take a photo or a screenshot, this is a list of questions I want you to go through for the exercise. Obviously, like I said, this is very software focused. If you're not software, if you're like hardware, whatever, think about the other questions, or just Google it. What do investors want to know from a hardware company? And add those questions in there and answer them. And I guarantee you, like, all the questions that are negative, it's not going to kill your business unless everything's negative. If the market size is bad and the timing's bad and the experience is bad and all this stuff is bad, then don't do that business. But chances are, if you're an Angel NV, you have a lot of these already, because they've already vetted you guys out. So you guys are already like a foot in. For everything else, go through, and if it's negative, do what I said earlier with the objections. Write it out and say, okay, here's, let's do an example. Adoption. I'm in a market with really slow adopters. How am I going to change that? What's going to convince people? Is it that the solution, is a 10x return on whatever they're paying me, and I can help them beat out all their competitors? Is that what's going to convince them? Like, really think through it and have that rationale ready for your investors. I'm going to stay on this slide because I think it's the slide with the most content, and if anybody wants to take a photo, but I think we got another question. How about clients when they say how much traction, what's the number, but how does one raise money to actually get to that point? Like fundraising to start the startup. Example, maybe complete the website. Oh, okay. Yeah, that's a really good question. So I'm going to be super frank and honest. Right now in this market, it is really hard to raise pre-revenue. It really is. There will be a few programs, probably local programs, that you can apply to get you off the ground. But because it's such a competitive market now, and what's happening is because people aren't able to raise at the later stages, they're coming back to the early stages. So I'll give you guys an example about our firm. Like I said, we make 120 investments a year. 80% of those 2 years ago, no, maybe not 80. 2 years ago, maybe 60 to 70% of those investments were pre-revenue. So it was people without any traction. They had a product, they had an MVP or a beta, something like that. But they were pre-revenue. And we helped them get their first few clients. We helped them with a lot of their sales, go to market stuff. Now, a lot of people that are traditionally raising seed that have revenue aren't able to. And so they're coming back and applying to our accelerator program. So when we compare these companies, it's obviously better investment for us to go with a company that has revenue because they're proving that somebody's willing to pay for that product. So whatever you can, I think in today's market, try as hard as you can to get revenue before you raise from anybody. If that's not possible, I understand completely. Try to find VCs that are a little bit more open to it. Maybe it's people that understand the business a little bit more, or maybe are a little bit more strategic. But for the most part, it's going to be very, very difficult to raise pre-revenue. If you don't have revenue, I will also say there's other ways to prove traction. So if you are, for example, consumer or even B2B, one of the things that's really good in a way to prove traction is your wait list. How many customers have you talked to? How many of those are on your wait list? How many of them said they will sign up? If you can, get a letter of intent. So if you have a relationship at Microsoft and they said, hey, if you build this product, we will use it, get somebody from the executive team, leadership team to sign a letter of intent saying, this is really this is really attractive to us. We will want to sign up if they build the product. Now, letter of intent isn't legally binding, so usually it's pretty easy to get. So VCs want to see you have a lot of them. Okay, a follow-up question. Would you be able to share the programs company that could help us out for people who want to raise pre-revenue? We are working on clients to work with us to get some reactions that's not revenue-based, but client-based. We are working on clients to work with us to get some reaction. Oh, right. Okay. So like basically pilots, like unpaid pilots. That's okay. Oh, I just answered it. Okay. Yeah. So yeah, unpaid pilots are amazing. If you can show that somebody's using it and you can show the feedback, you can drop that in your due diligence and say, look, or in your conversation and say, look, we don't have any paid customers, but we have 5 unpaid and it's all going really well. And all of them said they're converting. Excellent. Now the downside is the VC might want to wait until they convert. But yeah, I don't really necessarily know. Every program is different. Like I said, for us, like you wouldn't know that we predominantly are funding revenue companies now because it's not a requirement for us. Like if we really love the company, like I said, right, it's all about like what the associate and the partner think of you and how they pitch it internally. If we really, really, really love the business, we will invest in you regardless of what stage you're at. It's just that now when we're comparing you against other people that potentially have better experience or more exits in the past or a lot of revenue, it becomes harder. So every program is different. I couldn't tell you a program that specifically just does pre-revenue. I would assume if they compared you versus somebody with revenue, they probably want to take the revenue side. Okay. Oh, wonderful session. Thank you. Yeah, I think that's it. I stuck on this far enough, so I assume everybody took their screenshots and photos and stuff. Definitely do the recommended exercise here. Go through, be brutal. That's the only way you'll be successful, right? If you fully understand all of your weakness and you're that level of self-awareness. But yeah, if you guys want, oh, I don't have my information here, but I think my email is somewhere in the StartUpNV database, right, Maggie? You guys can reach
Yes, I
out.
can put it, it's hello. It's FayeAlmeshaan.com, yeah?
Yes.
Okay. Or Faye at.
And I have yeah, they both goes to me. I don't know why I have 2 emails. But yeah, if you guys want, you can email me, you can add me on LinkedIn. I try to help out entrepreneurs as much as possible. I'm always like, I post a lot of content that's relevant to early stage founders on my LinkedIn as well, if you guys want to follow. Oh, we got another question. For the person doing the free pilot, if you can, please try to charge something. Free pilots can be expensive in your part. Oh, yeah, that's true. Yeah, definitely try to charge as much as possible. But at the end of the day, if a free pilot is what's going to get your foot in the door to get some logos on your deck to say people are trying out your product, it's sometimes a really, really good option to get started and also a great way to convert. Because sometimes they're like, no one's used your product, I don't want to use it. But if they can use your product And then you hit all their metrics and you're really good about that sales cycle, saying, hey, what is the success metric you want to see? You run that pilot, and then at the end you say, hey, you saw all those success metrics realized. Can we convert this to a paid contract? And SaaS contracts are incredibly lucrative, right? On average, they're usually 3 years. So if you can do an unpaid pilot for 3 months, but then you get a 3-year contract for, you know, 100,000 a year, 200,000 a year, that's incredible. And that's the type of conversion VCs want to see as well, right? They want to see that people are using, liking, buying. Yeah, cool. All right, guys. That's it for me.
Thank you, Faye. That was amazing.
I'm out of breath.
Will you share your slide deck with us, or should they have just taken screenshots?
Yeah, I'm more than happy to share it.
Okay,
Yeah,
yeah, if you
just
can
send it to
send
you,
it to
Maggie.
me, then we send out the recording on Friday at noon with a link to the deck. And I took the screenshot of your questions.
Cool.
The VC early stage criteria. And
Mhm.
I'll make that into a separate doc that I'll upload too, that they can just have that one.
Awesome. Cool. All right, guys. Thank you so much. Thank you for being so engaged, asking so many thoughtful questions and so specific. I know that was a lot of content, so please feel free to watch the recording, check out the deck, or reach out to me. Bye.
Next week, we're having pitch practice and deconstruction. That's the time when we do our 1-minute pitches, and then everybody votes to hear from maybe 3 people in a 3-minute pitch. So come prepared next week. And we're trying to make that completely virtual, since it's prepping you for when you do your pitches to the Angel NV cohort, and that will be just completely online for the first 2 pitches, which is a 3-minute pitch and a 10-minute pitch later. So that's why we're doing it online, to get you used to the notion that you should be comfortable doing it with sharing your slides and speaking.
So there's no live, there's no in-person next week yet?
No, so we're saying there's no in-person. You should be planning to do it on your computer.
Thanks, Megan.
Okay, thanks everybody. See you next week.